It might seem that everything, and yet nothing has changed in the 12 months since our last update. Interest rates have been raised at a faster pace than expected, and yet inflation remains above target in most European markets as well as globally. The divergence in inflation across Europe is striking. Take Spain, for example, where moderate inflation has spurred interest in the growing residential sector. Meanwhile, Germany's inflation, though high, has retreated from its recent peaks. Overall, by next year, economists anticipate inflation to hover around the 2% mark in most European regions.
And with these shifts, the narrative around interest rates is starting to evolve. Much of the focus to date has been on when and at what level policy rates will peak at. While this narrative hasn't quite yet gone away, the spotlight is expected to focus more and more over the coming year on the timing and intensity of potential cuts. Forecasts vary of when interest rates will start to reverse, with some predicting the first ECB rate cut in Q2 2024, while others foresee later in Q3 next year. Interestingly, money markets are factoring in a slight chance of a rate cut by April.
Interest rate policy within the Eurozone is complicated further by the diverse economic landscape. We are already observing a surge in tourism-driven southern European markets like Spain. On the flip side, even while somewhere like Sweden is seeing soft economics, this is on the back of GDP, which is already well above pre-pandemic levels.
That's right. While higher interest rates and mounting debt costs have curtailed investment in some regions, Europe still stands as a prime destination for global cross-border capital. It's crucial to delve deeper than the headlines, as there are resilient pockets even in this landscape.
For example, Germany, despite economic headwinds, remains the largest destination for cross-border capital in mainland Europe, even though investment volumes are at a lower level than in previous years. While office volumes remain soft, inbound volumes quarter by quarter over the year have been increasing.
Over in Spain, hotel sector inbound investments have already surpassed the full year totals for the last 4 years, and this is supported by double-digit economic growth in tourism sectors. The residential sector, too, has seen investment volumes nearly 18% higher than the long-term average. More broadly, European investment is tilting towards areas with stronger structural tailwinds, notably the living and logistics sectors, which is nothing new. And while the European office sector might be overshadowed, it's essential to differentiate it from its US counterpart. For instance, the European office vacancy rate was below 10% at the end of Q2 2023, less than half that seen in many US cities.
Indeed. And despite prevailing uncertainties, there's a considerable pool of capital poised for deployment. The question is, where will this come from?
Well, private capital and safe haven investors, such as sovereign wealth funds, especially from locations with currency strength, are forecast to continue to target best-in-class real estate. Conversely, we expect to see more opportunistic investors selectively targeting secondary and tertiary real estate as it undergoes repricing, especially where leverage is challenging. This could pave the way for refurbishment to an improved sustainability standard, or repurposed where those assets have good bones.
From a geographical perspective, investors from regions with strong currencies and hedging advantages, like North America and Singapore, are likely to remain active in Europe. Japanese, too, are making their presence felt, especially considering their favorable cost of debt, and are expected to be significant players over the coming year.
The lending environment across Europe is also very diverse and at different levels of innovation. In some locations, due to the rapid rate increases on loans which are coming up to be refinanced, refinancing might also unveil new opportunities. Elevated debt costs in some cases are leading to equity injections, partnerships, and even asset sales. There are also pricing opportunities across Europe from shifting yields.
For example, prime office yields in cities like Munich, Berlin, Dublin and Frankfurt have expanded by over 100 basis points from their recent lows. In places like Amsterdam and London City, the shift is even more pronounced at 150 basis points.
So this is the immediate picture. There are also other drivers, though, which are expected to shape opportunities in commercial real estate over the region over the coming year and beyond.
Looking ahead, we can identify clear trends influenced by major infrastructure investments spanning from digital technology, transportation, energy, and the transition to net zero. Physical infrastructure, for example, is evolving new opportunities for logistics in Europe. A case in point is the Fehmarn Belt Tunnel, which will enhance connectivity between the Nordic regions and Central Europe, reinforcing the efficiency of the Green Banana logistics corridor. On the digital front, the rise of technologies like AI necessitates robust data infrastructure. Our research suggests a steady growth in European data center supply, with an estimated annual increase of almost 11% leading up to 2030. This presents a landscape of opportunities for investors.
Bringing this all together, across Europe's commercial real estate scene, challenges do exist, but so do opportunities, especially in logistics and living sectors.